Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about taxes this morning. As I said, it started out with the market. I know, right? Here's my geeky friend, nerdy geeky friend who likes taxes.
Exactly.
I mean, this time we just spent, by the way, yesterday with my clients when they come in. I know we set aside. I think we got 5 days this year that we've set aside, and we'll typically meet 10 to 12 clients each day. So it's a lot of back-to-back appointments. It's a long day, but we want to. The reason is we team up here because I'm a firm believer in that team approach. And Friday and I have known each other for 20 years, and we've worked together most of that time. She's done my taxes, of course, that entire time, both for my business as well as my payroll taxes as well as my personal taxes. One other thing, and I've referred a lot of people to her because she does a good job and she's very reasonably priced, and she, no nonsense. And if you need help, if you got questions, she'll take the time to help with that. She does a great job, and with so I've got a number of clients over the years that use her services for doing their taxes. I like to meet with my clients, and that's why we'll set aside days to fill up Friday's schedule. So we typically, as I said, set aside, I think it's 5 days this year, just for my clients. And we fill that calendar up. Work through lunch a lot of times to make sure, though, that we're sitting together with them. So when things come up, and we had one yesterday as an example.
One or two of them come up every time we do it. I mean, you think that if I do these things, I should have the right form so I can file my taxes, no problem. But when you get a 1099-R, many times Hank will either have people doing conversions or rolling money from one type of account to another account or whatever it might be. And keep in mind, all I'm doing as a tax person, I don't know what their financial plans are. I mean, I don't, and a lot of times the client may know it, but I'm sitting here with a form that specifically says this is taxable income.
Right.
And
you got to justify
I have to have some documentation to say it's not. Otherwise, you're going to get that sweet little love letter, and then you'll come back to me and say, "Hey, you remember?" And so that's where Hank is great.
I'll give you an example of why this is important too. One of the things that there's a thing called a rollover, and sometimes the terminology can trip people up. So if you call and you're saying, "I want to do a rollover," on the other end with your custodian, for instance, wherever your money's at, whether it's TD Ameritrade or Charles Schwab or whatever. One of the things that's going to happen is they hear rollover, they're thinking, okay, you want to take some money out and put it over into this other place.
Right.
Now, as far as they're concerned, here's what a rollover actually is. A rollover is when you take the money out of an account, put it into your account, and then within 60 days you put it into a different account. That's a rollover. A custodian to custodian transfer, on the other hand, is where I have it go from, say, Charles Schwab over to TD Ameritrade directly, right? Now, either that check, there's a couple ways that can happen. It could be made out to the custodian in your name. That's typically what will happen with, say, a 401k when it's transferred over to an IRA, is they'll send out, not always, but many times, they might send the check to you where it's got the new custodian, TD Ameritrade, for benefit of, and it'll have your name on it, and then you don't even have to endorse it because it's made out to the new custodian, but you would take it into your advisor and they would forward it and have it deposited into your account.
Which is great.
That's still custodian to custodian transfer.
That makes it easier on the tax person, because then there's a code G in box 7 which specifically tells us that you just transferred it from one account to the other account, and this is a non-taxable situation. But
what can happen if you just take that money, if you're saying rollover, and they send you a check, and they might even send the check made out to, you might said, well, make it out to Fidelity as an example, and they say, okay, here's this check to Fidelity. As far as they know, though, they don't know that it's an IRA. They don't know if it's a non-qualified account. All they know is you want X amount of dollars from your account, and you want it made out to Fidelity. So they'll send you the check. Now, they'll also then, at the end of the year, when you get that 1099, it's going to show, here's the amount that you wanted, right? Here's that distribution, and all of it is taxable.
Exactly.
Because you have not gone custodian to custodian from one IRA account to another IRA account. That creates a problem. Now, it's fixed. You can fix it. I don't like doing this, though, and here's why. Custodian to custodian, I can do unlimited amounts of those, much as I want. However, if I take the money out and I have 60 days for a rollover to get that money back in, then that's fine. I don't have any taxable consequences. muddies it up a little bit. I got to get a now new form, a 5498 form, from the new custodian showing that it was placed in there, and they can match up the dates and all that, and it's still not a taxable event. The problem is you can only do one of those a year. Okay, and that's where if if there's an error made, or in a situation we just ran into, there were actually 2 distributions, all right, or 2 different dollar amounts. Technically, that could have been looked at as 2 different distributions, 2 different rollovers, and one of them would have been disallowed under IRS rules and would have been taxable. Fortunately, they were two different amounts for representing two penalty-free amounts. They were combined, though, on the 1099 as one transaction.
Right.
So, fortunately, that was avoided. But this is why,
that's huge.
Don't go to your custodian by yourself. Get with your advisor to assist you with that, who knows the rules and can protect you against those kind of things happening inadvertently.
Huge, because people hear rollover every day. Whenever I just want to roll it over to my other account, the word rollover just is something that you've heard a lot of, or custodian to custodian. It's not something that's been kind of put out there as much as this is how you want to transfer your money, custodians. And again, that is huge, because then we have to prove, we have the dates, the IRS will come back, possibly say, and then we have the love letters coming in, and we have to deal with that versus a simple transfer.
In this situation, this person went direct to the custodian instead of going through our office. If they'd have gone through our office, we'd have been able to help them with that.
Right. You would hope that the custodian
we know the right questions to ask, and we know what we're doing. And that's where the custodians do not. And it's not, and they're not tax people. They tell you that right up front. It's not their job.
Yes.
They're there just to take your instructions and give you. So in this situation, they said, okay, here's the withdrawal.
$9,000
they sent her a withdrawal form.
That was the difference. When I had it in there and I'm telling them, okay, this is what you have, and then that's when she started looking and said, oh, wait, this was a rollover or a custodial. And I'm like, and the difference was $9,000. So
imagine she would have paid $9,000 more in tax. Now, again, we were able to get it taken care of
this time.
But it could have easily gone badly. Like I said,
because the 2 checks and the whole situation.
If you get more than one such account, or excuse me, more than one such transaction in a 12-month period, they will disallow. So, but this is the issue, of course. Make sure, that you've got a good advisor to help you with that, and the team approach that we talk about. So we're meeting with clients. A lot of times we'll run into other situations. We can clarify.
Stock
basis. If we're missing a 1099, we can easily download it and provide it. So all of this is a big part of why we work together and meet together with the clients. And that's why I do it with my clients anyway. I want to make sure that they're taken care of. And we've got this year, we're past the time for 2019. Is there any last minute things for people filing?
Well, really the only thing you could look in, and that's one of the things from my office I don't get into, but one of the things would be getting yourself an IRA. You can still contribute to a standard IRA to reduce your taxes up until April 15th. Or if you're self-employed, you may have a SEP, which of course extends, if you do an extension, it can extend all the way up to October. But those are really one of the few things. The biggest things normally I would say is looking at your withholdings when you file this year. Did you have too much? Did you get a $4,000 or $5,000 refund? Did you end up owing $2,000 or $3,000? Because kids grow up. People go out of college. Sometimes the year before you had a college credit, or you had a 16-year-old child. Now this year you have a 17-year-old. That's a big difference. $2,000 versus $500. You lose $1,500 when the child turns 17, or if they go to college and then graduate. So really looking at your numbers and making sure that your W-4 information is good, so you have the right amount of withholdings coming out. No one likes to write a check.
Yeah. This is one of the things we sometimes, when we're, one of the reasons for meeting again is many of my clients, most of them in fact, are taking money from their accounts because they're in retirement, right? So they're now starting to take the money out. We set up tax efficient income plans for them to minimize taxes. We look at Social Security. We're weighing all those things when we're setting up the plan. So when we meet each year, once a year we do the tax thing, and then of course we also meet at least one other time, and sometimes 3 or 4 times. But when we're meeting, it's an opportunity to review that tax part of the plan. Let's see how it worked out on the return. Did we do the right thing? And is there any little tweaking that we need to do to make sure to, you know, make it even better? And I'll tell you a story when we come back about a client that we have, for instance. Now in her planning, we've structured things in such a way that we're zeroing out her taxes. We've been able to do that for the last, I think it's 2-3 years now, and we've got another 2 years that we're going to be able to, possibly 3 depending. Would you like to know how that's done? Maybe you'd like to zero out your taxes. Wouldn't it be nice to sit down with your accountant and know that anything you paid in is coming back?
Exactly.
Right? Well, we'll show you how to do that. Join us here. We'll be right back on a Retirement Report.